Circulate the dollar, build the power. Communities rising every hour. For survival, the ownership we grow. Economic strength is the goal.
Most communities are not poor because no money ever arrives, you know. That's a common misconception. In fact, a tremendous amount of money flows into almost every neighborhood in this country. It comes in the form of paychecks from local jobs, paychecks from distant jobs. It comes from government benefits, pension checks, small business sales. People are constantly earning and spending. They buy groceries, pay for car repairs, purchase clothing for their children, get haircuts. On the surface, this activity looks like a healthy, functioning economy. But for so many, the feeling of being broke, of just getting by, never seems to go away. If all this money is coming in, why isn't it building lasting wealth? Why do the streets look the same year after year? Why are the same families struggling generation after generation? The problem is that the money doesn't stay. It arrives on a Friday with a paycheck, and by Monday, it has vanished. It passes through hands briefly, like a visitor with a train to catch, leaving very little behind. Imagine trying to fill a bucket with water. You turn on the tap, a steady stream pours in. You can see the water, you can feel its weight. But then you look down and notice the bucket has several large holes drilled into its base. The water rushes in, it drains out just as quickly. No matter how much you pour, the bucket never fills. This is the economic reality for millions. Their community is a leaking bucket. The constant flow of cash provides temporary relief, but it fails to accumulate into a reservoir of community capital. This constant draining effect is what keeps communities in a state of perpetual financial struggle. It creates a cycle of dependency where the next paycheck is all that stands between stability and crisis. Building wealth for an individual family or an entire neighborhood requires accumulation. Some of the money that comes in needs to stay put. It needs to be saved, invested, put to work locally. So, where exactly does all this money go? The leaks in the economic bucket are often hidden in plain sight, part of our daily routines. A significant portion flows out to large corporations, national corporations, multinational corporations. When you buy your morning coffee, your groceries, or fill up your gas tank at a chain store, the profits from that sale don't typically stay in your neighborhood. They are electronically sent to a corporate headquarters in another city or even another country to benefit shareholders and executives who have no connection to your community. This is a major, consistent drain. Another powerful leak is the rise of online shopping. With a few clicks, we can buy almost anything and have it delivered to our door. It's convenient, no doubt. But with each transaction, money is electronically transferred directly out of the local economy. It goes to massive distribution centers. It goes to tech giants located far away. That money doesn't pay the salary of a local shop owner, who might in turn use it to hire a local accountant or buy lunch at a local diner. Instead, it exits the community's ecosystem entirely, contributing to the wealth of distant entities. Then there are the fundamental costs of living, which have become major sources of leakage. For many, the single largest monthly expense is rent. That rent payment often goes to a landlord or a property management company that may not live, spend, or invest in the community. The money is extracted and consolidated elsewhere. Similarly, interest payments on car loans, credit cards, mortgages siphon wealth away. Banks and financial institutions collect these fees and profits, which accumulate on their balance sheets far removed from the streets where the debts were incurred. Each of these transactions, on its own, seems small. A $5 coffee, a $50 online purchase, a credit card interest payment. But when you multiply these by thousands of people, day after day, the numbers become staggering. The core issue that allows these leaks to persist is something we call the ownership gap. There is a fundamental difference between earning a wage within an economy and owning the assets of that economy. A job provides you with income, which is essential for survival. You are paid for your time and your labor, but ownership provides you with control. It provides profits and the ability to build equity over the long term. When the majority of people in a community are only earners and not owners, they are essentially renting their own economy from outsiders. Consider two grocery stores. One is a local branch of a national supermarket chain. It employs local people, which is good. But the building is likely owned by a real estate firm in another state, and the profits from every sale are sent to corporate headquarters. The major financial benefits, the profits and the property value, are extracted from the community. Now, picture a grocery store that is owned by a person or a group of people who live in the neighborhood. They still employ local people. But now, the profits from the store stay local. The owner might use that profit to renovate the building, hire more staff, or open a second business down the street. If the problem is money leaking out because of a lack of local ownership, then the solution must be to build local ownership. For individuals facing economic pressure, this can seem impossible. How can you afford to buy a building or start a business when you are struggling to pay rent? The answer lies in a powerful, age-old concept: group economics. This isn't a radical new idea. It's a practical strategy where people pool their resources, their skills, their efforts to achieve a goal too big for any one person. Group economics is not charity. It's a disciplined, organized strategy for collective self-reliance, a conscious decision for a group to act as a single economic unit. By combining modest financial power, community members can begin to own assets that shape their lives. Shift from individual consumption to collective investment. Instead of 10 people buying 10 products from outside, those 10 can pool money to build one shared asset. Let's break this down with a clear, simple example. Imagine 10 friends or neighbors who recognize that their community lacks a decent local laundromat. Everyone is spending money at a facility owned by an absentee landlord. They decide to act. Each of the 10 people agrees to contribute $200 a month into a shared fund. In the first month, they have $2,000. It's not enough to buy a business, but it's a start. They open a joint bank account and create a simple agreement. They are now an economic unit. After 1 year of disciplined saving, their fund has grown to $24,000. They can now use this capital as a down payment to secure a small business loan to purchase the laundromat or to buy the necessary equipment to start their own. Let's say they buy a small existing business. They are no longer just customers. They are now the owners. The money that community members spend on washing their clothes now flows to this group of 10 local owners, not to an outsider. Here is where the magic of circulation begins. The business generates a profit. The group must then decide what to do with it. They can choose to pay themselves a dividend, hire a local resident to manage the laundromat, improve the service, or save for the next purchase. It's not about a single, massive injection of cash. It's about capturing the existing flow of money and keeping it circulating from one neighbor to another, building layer upon layer of shared prosperity and local control. If this topic is important to you, subscribe to Circulate the Dollar TV and start a discussion in your own town about its unique economic challenges.